Good evening, everybody. Welcome to another edition of several webinars that I will be hosting for Trader24. I'm just going to wait one more minute for a couple of people to join us, and then we'll get underway. Okay, I'm going to get going. The natural kind of progression that we want to go through was, get the basic understandings of the platform, and then now we're getting on to the more relevant stuff, which is obviously learning to trade and coming up with the correct way and disciplines to obviously trade on the financial markets. So basically what we're going to be talking about tonight is coming up with we're trying to define your trading plan, how to approach it with a disciplined trading technique. One of the millions of techniques that you can use out there is breakout trading. So that's what we're going to talk about tonight. Some basic chart patterns, and I think it's quite important to get those chart patterns under the belt as quickly as possible. So going forward, when I talk about various different patterns, you'll know exactly what I'm referring to. And then I'm just going to basically come back and just summarize everything. And, that should probably take us about 40-45 minutes, somewhere along those lines. Okay, so, when you are looking at a trading plan, you need, to actually just write these things down, quite honestly. So the first thing I've said here is know yourself, know your purpose. Okay, so what I mean by that is, what sort of personality are you? Are you sort of an aggressive trader, or someone more that likes to hang back and has less risk appetite? So you've got to understand that itself, because really there is no real trading technique that works well for one person onto the next person, because we have different trade characteristics and personalities. So know what you're looking to achieve with your trading. All right. What I've said here is have trading goals. So set yourself realistic goals. So what I like to do is say to a client, well, what are you looking to achieve with this money over the space of a year? I mean, what is a realistic return for you? And then break it down by month and then by day. And as soon as you break it down like that, you're then able to calculate the lot size or trade size that you should be doing. And all of a sudden, the goal that you were looking towards, that you thought was just so far away, is actually very, very attainable using a low-risk strategy. All right. And moving on to step 3 there, as you will see, I said, get to know and identify the markets, instruments, and timeframes that you want to trade. So once again, I want you to actually write these things down. And what we're going to go on to at a later date in one of the webinars is how to create a trading slate, which is what most professionals will use. They'll have all the instruments that they are looking to trade, whether it be gold or euro dollar or a pound dollar, whatever they are, feel best capable to make returns on. That is what they will trade. They will identify the time frames on which they want to trade when it comes to their charting, and they're very, very disciplined when it comes to that. Okay, so before the market opens, you want to get a little bit of homework under the belt as well. So what you would be obviously doing is, let's just say, for instance, I'm trading gold. Well, I want to know everything that pertains to gold. So I'm looking at things like the US dollar. What's it been doing? Are there any news announcements that could potentially affect the US dollar? We need to look at COMEX, the exchange, and see what's been going on there with relation to gold. So all these sorts of things that you need to sort of think about before you are looking to get into your trade. Do your homework first. See what the markets have done before, and see how the rest of the world has reacted to that data. Of course, and this is the thing I harp on about all day, every day, is risk management and money management. That is the cornerstone of every successful trader. And if you want to make a go of it, you need to get that sorted out pretty quickly. You need to have an exit strategy. We're going to talk about that tonight. It's obviously almost more important than your entry point. You need to know your exit point, pretty much so you can define your trade as you go along. We're going to talk about various different trade strategies, setups, and entries. There are techniques that I'm going to talk about tonight which you can utilize. after the market closes. Now this is just as important for me. For instance, if you have started to create your trading slate, whereby you are recording all of your trades and whatnot, after a while you get to build up a picture of the way that you are trading, and whether you are being disciplined enough and all that kind of thing. So I want you to get into the habit after the market closes. Firstly, have a look at see where the prices do close, and then go back to your trading slate and have a look, see how you performed on the day. Did you trade well? And the trades that were profitable, why were they profitable? The trades that were made losses, why did I make a loss, and did I cut out at the right time? So you need to establish all of these golden trading rules, to make yourself a successful trader. All right, so I've got what I call the 3 M's here, and the first one we're going to talk about is mindset. All right, so the first thing you need to have is your attitude. How do you react to movements in the market? And how do you react to the money moving in and out of your account? That'll give you a good idea, quite honestly, of what sort of trader you are. If you feel that you're in too big a position and you can't sleep at night because you're worried about what that position is doing, well, the chances are you're more of a risk-averse person, and you need to probably gear down on the size of your trade. Okay, have self-confidence. So believe in yourself, believe in the ability that you have, believe in the strategies that you put in place. That really is the key thing here, is making sure that whatever strategy you do use, make sure that you apply it and actually just have the faith in it. You've seen it, try and test it before you going live with that particular strategy. All right, so you just want to keep it as objective as possible. If you can, try and think of money as a less serious commodity, if you can do that. But you really need to just sort of have faith in where your entry and exit points are, and have faith in the way that you have identified those particular trades. All right, discipline, as I said, you want to stick to your plan. Don't veer off it. If you set yourself a stop loss at 2%, and you then decide to move it down to 4%, chances are the 4% will get hit anyway, and you're going to just end up kicking yourself. And then finally, patience as well. Watching and waiting. If you miss one trade, trust me, there will be others in the market. The market never sleeps, so trust me, there will be other opportunities. And the good thing about the market as well is that in the course of a year, you probably get about 4 to 5 absolute dead certain no-brainer trades. So if you can really sort of be patient and hold on looking for those, you can achieve your whole year's potential target in just those 4 trades. So patience is really the key. Okay, the second M I'm going to talk about is obviously money management, and I've given a quote here. The most important thing is money management, money management, money management. Anybody who is successful will tell you the same thing. So I'm going to hop on about it, but that is really the key here. All right, and I'm going to just basically talk about an example here. What we wanted to look at is capital allocation. So how big a trade should I be placing in relation to the actual portfolio? Okay. Basic rule of thumb: I only ever like to have 50% of my money actually sitting in the market itself. That would be my margin money that I have sitting available there. From there, obviously, I would then create my position size or lot size and just say, right, well, of the 50%, I'm only willing to risk maybe 3% of that capital, and that's where I would put in my stop losses. All right, so that, once again, is just a basic rule of thumb, and it's dependent on the way that I trade. It might not necessarily be where you want to put your stop losses. So once again, identify how what you're looking to achieve with your trade. Okay, so what we're going to talk about is setting stop losses. Okay, so for each trade, where do we place our stop losses? We can have an initial stop at a technical point like a support or resistance line or something like that. And we're going to basically just go through an example here And what I'm going to talk about is just how to create a position size on the euro dollar. Okay, so let's just say, for example, I wanted to buy the euro dollar at 133. Okay, and I've just taken an average example here of an account that has 100 grand, 100,000 rand sitting in the account. And I've said to myself, right, well, I'm only willing to risk 2% of my portfolio if the trade goes wrong. So that's 2 grand effectively. All right. So from there, I can set I've decided to set a 3% stop loss, which basically equates to 1.2901. How I get there is 133 times by 3% gives me 91 pips. Subtract that from the 133, and that's how I arrive at my figure of 1.2901. All right. From there, I can then calculate my actual lot size, and that's really what it's all about. Okay, so I'm only willing to risk 2,000 rand. Okay, I times it by my amount of pips that I'm willing to risk, divide that by 100, and that'll give me my lot size of, well, let's just call it 0.20 for the sake of round numbers. But if you want to be precise, it would be 0.182. All right, so if the market moves by 91 pips in the opposite direction to where I want it to go, and I will get stopped out at 1.2901, which is a loss of 2,000 rand, which in effect is a 2% loss on my portfolio. Okay, so that's the lot size of your trade. Guys, this is being recorded and it is going to be put onto our YouTube channel, so if I have gone through it a bit quick there, you can always go back to it, and this will be there. These calculations are there as well. All right, so the margin also required here is 1,330. That in relation to the size of my portfolio is obviously very, very doable. Okay, so I'm going to talk about stop loss strategies. Basically, it's the place where you admit that you got your trade wrong. Quite honestly, the market will tell you when it reaches the stop loss point. If you put your stop in the correct place, you'll be closed out effectively. And the key thing here as well is cut your losses and move on. Don't go chasing losses. I've seen it happen before, where the person makes a big loss. So what they're then going to do is try to double up the size of their next position to recoup these losses. That trade goes against them, and they eventually end up losing all their money simply because they didn't follow the disciplines. All right, we have stop losses in place for a reason. Please don't go moving your stop losses further away, because ultimately you're going to just incur further losses. Okay, so one of the ways that I like to identify where a stop loss should be placed is on the chart itself, or if you're used to using technical analysis. Some of you might only like to use sort of a percentage-based stop loss. And once again, it really is up to you. But as I say here, it's the first thing you need to know about a particular trade. All right, so we need to understand firstly the risk from a stop loss perspective, and which then will obviously translate into a monetary risk as well. Okay, so we can decide how many lots to trade so as not to exceed maximum loss per trade, which you would have determined in that trading plan. Right before we got trading, we would have said these are the biggest positions that I want to trade on the euro dollar, for instance. This is the biggest position that I want to trade on gold. So I've worked out what my margin requirements are for each product as well. And just from there you can just define what type of trader and what kind of exposure you want in the market. All right, but the first step is to follow your stop. Right, and there we go. That's the one final thing I'll leave you with there is have a lot size you can live with. As I say, if you can't sleep well at night, just thinking about where your stop loss is, you've either got it in the wrong position or your position is the wrong size in relation to your portfolio itself. Okay, so a technical stop loss strategy is placed at a logical point on the chart. So what I either look for is a breaking of a support or resistance level. For those of you who don't know what those things are, I'm going to go through it a little bit more at length just now. breaking of a trend line as well. These things all go hand in hand with each other. Support and resistance, trend lines, Fibonacci lines, pivot points, they're all very relevant levels. Simply because the market is cyclical, it does repeat itself, history does repeat itself, and that's just the nature of the human psyche as well. So, those are always relevant potential entry and exit points. Okay, highly recommended because the chart tells you where to place the stop. It's an easy one to spot. A picture's worth 1,000 words. So it's always easier to notify or spot a stop loss off a chart rather than having to calculate it yourself. All right, so one of the next 3 M's is method. All right, and what we're talking about here is breakout trading. All right, so first I want to identify where a potential breakout could possibly be. So what I'm looking for is a particular trade which is close to a support or resistance line where we see the actual price continuing either in that upward or downward momentum. All right, and we're going to wait for that breakout. We're going to wait for that trend line that it hits to actually get broken through, and we are then going to wait for our candlestick to be completely finished in terms of the time frame that we are trading before we make a decision. Because often what we see happening is the trend line will get broken early on, in the candlestick formation. But by the time the actual candlestick is completed, the actual candle has finished below or above the particular support or relevant resistance line, and suddenly this wonderful breakout trade that we had all planned goes to pot simply because the trend just rather either sort of filters out or just continues in the opposite direction. Okay, so we're going to set a reasonable price objective. I think that goes without saying. And allow the instrument to retest. And this is very often what will happen is the trend will get broken, and it will get nicely broken. But because we have that established trend line, what traders like to do is pull it back towards the average. They try to pull it back towards the trend line before it continues on in the direction that they anticipated. So I'm going to show you what I mean by that sort of in graphical terms later on, but just kind of bear that in mind. All right, and also know when your trade is failed. I'm going to show you how to do that now as well. And exit trades towards the market close. If possible, try not to leave any trades open overnight if you're a short-term or intraday trader. It's nice to have a clean slate at the end of the day, so we can do a little bit of analysis as to how our trading techniques are going and whatnot. But obviously, if you're in for a longer-term trade, you're more than welcome to obviously do so. All right, and there once again, just be patient. Those trading formations will happen. Okay, and then also another big important one is exit at your target. Now that might seem a bit random to a lot of you, but I've seen it happen so often again as well, where the traders will have come up with a take profit target. And I say, oh well, it's hit this. I'm going to stick in for a long haul, and all of a sudden, what profit we had now turns around, and we actually end up incurring a loss simply because we could have got out a lot earlier and we didn't. So stick to the disciplines, people. All right, so here we go. I'm going to talk about support and resistance. And the important thing is the more times the prices touch these areas, the more valid these levels are and the more important they become. All right. And the longer these support and resistance lines are in play, the better the outcome when the price finally breaks out. So here we go. We have a look here. Let me just get my little pointy spotlight here. Okay, so we've got some resistance lines here happening at the top. So we see the price has hit here, almost like a price ceiling, and then has basically kicked off that level. We see it come back up to retest the resistance level. Once again, the resistance level holds. And then finally on the third one, we actually get a breakout. And what we see here is just above the resistance line, we actually see a completed candle occurring. All right, and in this instance here, it didn't come back to retest that particular resistance line. A clean broke through it, and our entry point wouldn't be down here. It would actually be at the completion of the candlestick above it, and we'd obviously be doing a long trade here in this instance. Okay, so this is now a failed breakout that I want to talk about. So we can see on the left-hand side, we have the initial breakout of the trend right here. Okay, and we see this thing break out, and you think, oh, lovely, this is going to be a nice long buy to the upside. We actually see it come back to retest this trend line, but this breakout has actually just completely failed. All right, so what we would be looking to do here is we would have established either our buy up at the top here, or as it retouched this buy here on the trend line. If it doesn't go our way, what we're looking for in terms of stop loss would be, you see this horizontal line here, which is the last available high price that was made. All right, so that's basically where we would put our stop loss. Okay, so we're going to talk about a few entry points. Once prices are set to close above a resistance level, a trader will establish a bullish position. Okay, so what that means is we're looking to buy. We think that it's going to carry on in our upward direction, and we're going to carry on buying. But just remember, we want to see a complete candle break above the resistance level. Maybe wait a little bit to see if it retests that resistance level. If not, then I'm happy to go for a buy. Okay, when prices are set to close below a support level, a trader will take on a bearish position. So we would actually sell that particular position there. Okay, so what you have to ask yourself is, how long am I planning on being in this trade? It really depends on what type of trader you are. You have to identify, what length or what span of time am I looking to get into a trade for? How many pips am I looking to gain off this particular trade? From there, I can then calculate, well, if I'm looking to make 100 pips, well, then I can, anything less than that, I can put as a stop loss level. I don't want to go and risk 200 pips to only make 100, because that doesn't really work out for me. I'm taking double the risk to only make half the return. It doesn't make any sense whatsoever. All right, so how much risk am I willing to take? Setting near-term profit targets that I can execute at opportune times to maximize profits. All right, so one of the big mistakes, and I think I might have put it in here later on, one of the big mistakes that clients tend to make, and they tell me all the time, is they'll say, right, well, Mark, I'm getting 8 out of 10 trades right, but I'm still losing money. What he's basically doing wrong there is, the 8 trades that he's doing, he's only taking small profits on the 8, but then taking big losses on the other 2. So it should be the other way around, quite frankly. So we wanted to make sure that the risk profile is correct before we get into the trade. Okay, so some common execution points. We can use things like Fibonacci levels. For those of you who don't know what Fibonacci is, I highly recommend you go Google it. We will talk about it in one of our other webinars, but for the time being, have a look, see what Fibonacci's are. We can use trend line breaks, like support and resistance lines. Any other sort of technical points that you can use. Pivot points are also useful. You could incorporate things like MACDs or RSIs or whatever you feel you can establish. But what I like to do is at least you look for confirmation from 2 or 3 different indicators. Number one, I like to use candlesticks. I've always got my trend lines and support lines and resistance lines all joined on there. And I'll use maybe 1 or 2 other indicators like an RSI or something like that. Not to establish trend direction, but rather a more precise entry point. That's really what I'm after when I utilize those kind of indicators. Okay, developing solid stop loss points that immediately get rid of holdings that do not perform. So we want to cut those losses pretty early. But and this is the art to it, is not putting that stop loss too close where we can see a market spike and we see that particular trade closed out. One of the ways that you could obviously counter all of that, all the volatility, is to reduce your lot size. So what I mean by that is, you know, instead of trading it at one lot, we can maybe trade it at a half a lot, and we can then put our stop loss further away to obviously ride out that volatility. Okay, create exit strategies based on technical factors affecting the short term. All right, so there what we're looking at for this breakout technique is using shorter term time frames and indicators that work well on those time frames as well. What you'll find over time as well is that certain indicators work really nicely on certain products and certain time frames than it does for other products. So it's just a case of fiddling around with that until you come up with the right mix of indicators and time frames. Okay, so whereabouts do I want to get out? And this I see every day. You know, people become married to their position. All right, and what happens is the underlying fundamentals of the trade have changed, and they still hold on to the position when they should rather just cut it all together. Another thing that people tend to do is they worry and sell their holdings even when there's been no change in the underlying fundamentals, and that's what we've seen happen recently over the last few years. Is that you know, ever since the market crashed in 2007 or 8, you know, people, you know, sentiment has really been battered, you know, around every little bit of market news that comes out. We tend to react a lot more significantly to it because we're a bit more fearful of the volatility in the market. You know, and so quite often we'll see this data come out, and it's not nearly as bad as what you really thought it was. And we tend to just panic a little bit. And both of these situations can lead to losses and missed profit opportunities. Setting a point at which you will sell takes the emotion out of trading. And that's obviously the important thing here. We want to keep discipline and keep the emotions out of it. As most of you will have found out, you know, trading is an emotional thing. And the whole concept here is, if I know the point at which I'm entering, my potential upside, my potential downside, and I can live with that, and I've put these levels in for a particular reason, well, then I can walk away from the trade altogether because I know it's all automated. I know what my potential profit is. I know what my potential loss is, and really the emotion does go out of it. I might go back and view it just to see if it's worthwhile, maybe moving my stop loss to my break-even point. But other than that, I'm happy for this trade to go ahead. Okay, so I've said here the exit point itself should be set at a critical price level. All right, so once again, I've gone back to sort of Fibonacci levels, but you know, you could use once again horizontal support or resistance, or in fact trend lines as well. You know, so there's a multitude of different ways to get in and out of these things. But really, what I'm trying to teach you here is it's more about the discipline of what the relevance of that particular trade would have on the actual portfolio itself in terms of money. Okay, so a quote here: while amateurs go broke by taking large losses, professionals go broke by taking small profits. So that's what I was talking about earlier. You know, what we need to do is cut our losses short and let our profits run. You know, so if you can, try to run your profit to loss at about 3 or 4 to 1. You know, that way at least we can make, you know, 2 trades wrong, and the next trade will be profitable, and we'll still come out with money. So we need to try and sort of get our head around that. Okay, now this is going to be the introduction to the sort of the technical analysis that I mentioned earlier, and we're going to be talking about some chart patterns. What we have here is continuation patterns and reversal patterns. What I want you to focus on initially is your continuation patterns. Only once you kind of are a little bit more expertise has improved, then I want you to look at reversal patterns, because I want you to try trade with the trend initially. Having said that, obviously the next slide would be reversal patterns, which is typical, but I'm going to go through the reversal patterns here anyway. And where we would use these is on identifying changes in a particular trend and trying to catch a particular portion of the trade in the opposite direction. So, basically what we have in the top left-hand corner, there is something called the double top. And what we see happening here is we see an upward trend. It hits a level of resistance and then comes back down and forms almost like an M shape. And what we would actually do here is we would get into a short position here. So we would sell when it breaks below the base of the M. And so we're looking to actually take advantage of this move over here on the right-hand side. Okay. Moving on to the double bottom, it's the exact opposite of the double top. So we see like a W formation getting formed. We would have an initial downward trend here, hitting a level of support a couple of times, and then at the sort of the apex of the W on the opposite side, we would look to get in once we see a solid break through that particular line in the opposite direction to the trend itself. Okay, so we got on the other side here, rising wedge. So we'll see we have a nice sort of uptrend here, and as it approaches the apex of the wedge, we tend to have a breakout either to the upside or downside. And basically what we're looking to do here is get into the trade sort of as it breaks the sort of the support line of the rising wedge, and we would then look to take advantage of a short there. On the opposite side of it, we have a falling wedge, which is a sort of a mirror image of that, and we would then in turn, in a downward trend, we would look for an entry point through the break of the resistance line to the upside. So we would then take advantage of this move over here to the upside. Broadening formation I'm not really a fan of, but I'm going to put it in here anyway. So we'll see the sort of the prices making higher highs and higher lows. And eventually what will eventually happen here is it'll either break out to the upside or the downside. But as I say, there's so many other formations that I find are so much better to identify that I'm not really too interested in that one, quite honestly. One of the sort of most traditional formations that you'll hear about with traders is head and shoulders. All right. And what you'll see happening here is the price will continue an uptrend. It will form like a shoulder, what looks like a shoulder here. We'll then go back a higher high, come back down to the shoulder, and then what we're looking to do is here, this is the entry point as it breaks through the shoulder on the arm there. And then conversely, we have the inverse head and shoulders in a downward trend. We get our shoulder formations, there's the head there, and we're looking to then buy as it breaks through this line here. I think I'll go more in length. We'll make it actually a nicer sort of a picture in the following slides. But let's have a look, see what we've got. Okay, so here's an example of a double top. All right, so this is the M formation being formed. We see resistance here, the top one. We've got resistance at top two. This is the base of our M being formed here. And the important thing is that we see a break through that line. Okay, so we see a nice solid red candlestick being formed. It comes back to retest. So we could have either bought, we could have either shorted at the base of this candle, or come back and shorted off the support line here to catch this move down to the downside. Double bottoms is obviously the mirror image. So this is the W that I was talking about. So we see this W formation being formed here with the bottom one and bottom two. And the important thing, once again, as I said, is that we look for the break through the resistance line. We see a nice strong breakthrough here. So we'll be looking to buy, and try to catch this upward movement through this resistance line. Triple top is just an extended version, really, of a double top. But notice how the price forms three relatively equal peaks before signaling a sharp move lower. And this was actually quite a nice example of it. where we see like this massive gap off between through this actual support line here. So this like when you tend to see gaps happen like this, it basically indicates that the market is in large agreements that this particular thing is bearish. That we're quite keen on the price dipping a hell of a lot more than where it was initially. All right, so here's a triple bottom, and once again we got a strong breakout through the support at the top there, and so that would basically be where our entry would be. So what we're looking to do is, just draw in your trend lines, and all of a sudden this all starts to kind of make sense. I always like to keep my trend lines and horizontal lines in there because they're always relevant, as I say. So keep those things drawn in there. If you're drawing in a good trend line, it will be significant. Okay, so here's an example of a head and shoulders. So what we can see on the left-hand side there is we see one shoulder being formed, basically then forming that basis support line. The head itself makes a higher high, but fails to continue upwards. So we see it retracing back down to the support, back up to form the other shoulder, and then finally we see the breakdown through the support line at the bottom, and that's where we would be selling. All right, with the inverse head and shoulders, same story here. We've got a nice neckline being formed. And it doesn't always look as clear as what there was in the previous one, but as long as you got your lines drawn in, it can be quite easy to spot. So we've got our shoulder being formed, the head up through here didn't break through there, so now we've got our other shoulder being formed, and because we've got our nice long horizontal line in place, we see a nice breakout on the upside here. You'll actually also see a nice increase in volume as well down here if you're using a volume indicator. So I'll be happy to go in and buy there as well. Okay, so one thing that's one sort of basic technique that you can use in terms of identifying a target for a head and shoulders target price was we see here our shoulders being formed, our respective shoulders. We see a break through the neckline of the head and shoulders, and basically what we'll do is we'll take the price from the neckline to the height of the head, all right, and we would then utilize that on the downside to identify our target to the downside. So that's one of the basic techniques you can use. I mean, it's up to you how much profit you're looking to go for, but that is a basic one that tends to work. All right, so here's an example of a falling wedge. So what we see there is, as we basically get through to the upside, we're seeing, the apex rather. What we should see here is a breakout through to the downside, because we had an uptrend here, we should be seeing this break off down further. Rising wedge, basically a good example here. This is actually a really nice one. So this was a continuation pattern, converging into an apex. You see a final nice big breakthrough that support line, and we would then be selling off here. Once again, let me reiterate, wait for the completion of your candlestick before identifying whether you want to get into these trades or not. All right, so that was basically our reversal patterns. Now we're going to be looking at continuation patterns. The top left one, really, if you can find one of these, it really is one of the easiest things to trade. What you'll see happening is we've got a really nice support line, and we've got a really nice resistance line, and the price just bounces in between those two. And if you can really find one of these, it is just so easy to trade. I mean, just out of this particular one, I probably would have got 4 or 5 trades out of it, just bouncing in between 2 price levels. So that's a nice little technique to have when the markets are quiet, not when it's volatile. When it's volatile, you're not really going to get a rectangle formation like that. Okay, we've got a flat top ascending triangle there. So what we'll see is we'll have an uptrend, all right, but we will be making a resistance, okay, like a horizontal resistance there. And it's, as it approaches once again the apex, it will then break through that resistance line and continue on in the direction of the trend itself. Conversely, if you with a flat bottom or a descending triangle, we'll see a downtrend hitting a level of support, and as the downtrend continues towards the apex, it has no choice but to break through to the downside, and we will continue on that downtrend and actually sell this particular trade here. Symmetrical triangle, very similar here as well. So we would have an uptrend, and what we'll see is it's making higher highs, lower lows. Sorry, wrong way around there. Basically, I was making lower highs and higher lows to end up with this apex at the corner, and then I would look to buy it as it breaks out to the upside. All right, so here's an example with the resistance and support drawn in. So as you can see, I mean, it is a little bit ragged. It doesn't go in a nice straight line, like obviously in that example I had before. But you know, we can still look for these entry and exit points. It might not be exactly on the line. It might be a couple of pips, you know, on either side, but it's going to give you a relevant point of entry and exit. Okay, here we go. In regards to triangles, this is quite a nice little example here where it actually is feeding quite nicely off these two resistance lines and support lines, and this is really behaving quite nicely. All right, so we can see here that the initial trend was up. All right, and we're just making sort of higher lows all the time and just sort of picking along on this support line. So I'd be looking to buy all the way along here, and then certainly once it breaks through here, I would look to buy to the upside as well. Okay, so here's an ascending triangle. Trader will enter into a long position on break above the resistance. So we'll see there that you know, it does have a big, nice break through the horizontal line. It stays up there. That candle completes up there. There's a little bit of indecision around here, but that's fine. I'm happy to buy at this point, and off I go. All right, and probably what I would probably do here in terms of a stop loss is just down at the bottom of this long blue candle that's been formed. I would probably have put my stop loss somewhere in this vicinity down here, just somewhere below it, and that would be my stop loss point. All right, so here we have a descending triangle example. Traders will enter into a short position on the break below the support. Okay, so we see it getting broken below the horizontal. It stays there. It thinks about it for a little bit, and this is the point where I'm looking to short it. Same story here. I probably would have had my stop loss level just above the red bearish candle that gets broken through the horizontal line itself. Okay, so here's basically an example of a flag. You notice how the price continues in the direction of the original trend once the price breaks out of the flag. So here we have our uptrend. We have a flag being formed to the downside. So we've got our resistance line. We have our support line. But really what I'm looking for is this nice big bullish candle that has been formed outside of my resistance line. I would then continue on to the upside. Pennant is very similar to you know, your flags and symmetrical triangles. Here we once again we've got an uptrend here. As we approach the sort of apex, we get a strong breakthrough here, so I would buy there around this level. But here we go. This is a good example of that trend line getting retested. So it probably would have been close to being stopped out here. Just really does depend where your stop loss was, quite honestly. And that's fine if we don't get, we're not going to get them all right, as long as we've got those stop losses in the right place. All right, so just in summary, guys, make sure you develop your trading plan. Okay, think about the 3 M's. So your mindset, you know, make sure you got your disciplines right. Identify the size trades you want to trade, what you're trading. You know, think about your attitude and self-confidence. keep it objective, be patient, keep disciplined. All right, money management, identify the size trade you want to trade for each individual trade as well as instrument. Think of a good stop loss level. And then this trading breakouts technique really does work quite well, because what I'm trying to teach you here is trading with the trend. We want to see sort of new highs and new lows being formed, and it really does work well. All right, so we're looking for breakout of support and resistance levels. We're looking for continuations patterns in the market itself. All right. The nice thing about breakouts is that it does like volatility. Remember what I did say, like the one thing where we don't like volatility is that rectangle formation, but for the rest of them, it really does like the volatility, because you're looking for that big break through your trend lines. Okay. The volatility experienced after a breakout is likely to generate emotion because prices are moving quickly, and that is reality. We can't help but get a bit emotional when we see the prices moving around that quickly. But you know, these tend to happen pretty quickly in terms of the breakout, and then things tend to settle down after that. All right, using the steps and information covered will help you define a trading plan that, when executed properly, can offer great returns and manageable risk. Okay, so that is what we're talking about here. All right, and that is it in a sort of a nutshell. Guys, this is probably one that you're going to have to revisit, I would imagine, on the YouTube channel, just simply because there was quite a bit of things to take in there. I'm obviously going to stay online just to address any questions you might have. And just going forward next week as well, we're going to continue on our sort of trading 101 adventure, if you want to call it that. How to create a trading slate, some basic technical analysis, what works well in terms of your RSIs and MACDs, and what's a Fibonacci and all that kind of thing. So we're going to get more technical next week. But thanks very much for attending tonight. As I say, I will be online for a little bit longer. For those of you that haven't attended one of these before, you can basically post your question on the Citrix webinar facility there, and then I'll obviously address it. Got a question here from Musa. How do I view the resistance and support lines? Musa, this comes through practice. You obviously need to, well, quite honestly, the best way to view them is to put these things onto your chart yourself. There is a facility there on your charting package to include trend lines. And what you're looking to do is kind of sort of match up the price points that get hit a lot. All right, so basically you just draw your line on and see how many times that particular line gets hit. All right, and what we're looking for is the outermost high points and the outermost low points. Okay, so that'll basically give us our support and resistance lines. Are there any other questions, guys? I've got a question here. Where can I get more examples of support and resistance? Yeah, listen. Quite honestly, if you Google it, there's a whole bunch of it. I can try to track down some basic readings on support and resistance. And what I'll do is for everyone that attended tonight, I'll mail it through to them. Yeah. Or alternatively, if you wanted to chat a little bit more about it, get in touch with your account manager as well. They'll be more than happy to either send you some material or just sort of talk you through it. All right, got a good one here from Robert Cecil. He says here he's currently using a moving average 30, 50, and 100 with parabolic SAR to determine trend. Do you think I have the correct idea to determine trends? Robert, presumably you're using those on a day chart as well, hey? I assume that you are, because that's obviously fairly relevant, and I think I've seen one or two of your trades as well in terms of the length of time you're looking to get into it. So yeah, I think those are pretty good. What I would also include is a 200-day. That for me is if you're getting in for a longer term trade, you always want to be aware of 200-day and 100-day moving averages because they tend to, well, firstly, the 200 is going to give you whether it's bullish or bearish, and in terms of stop losses, they very often tend to bounce off the 100 and 200. So I would definitely include that one. Parabolic SAR, not a bad one to use in terms of identifying where to also put stop losses. I know that gets used quite a lot for that particular identification of where to put stop loss. What else? I mean, as I said, there's a hang of a lot of different things that you can use here, but not bad at all in terms of that. I presume you're using those 30, 50, and 100s for sort of crossovers to identify entry points and exit points. But as I say, I would probably include the 200 on there as well, but I don't want too many on there, otherwise it's going to look like spaghetti junction. But certainly that one I'd throw on. I would use those obviously in conjunction with trend lines, support lines, and then just like pivot points and Fibonacci retracements are always good levels as well. Does that answer your question, or is it a little bit too much? Any more questions, guys? Got a question here from Musa. When does the market open and close? It depends on what you are trading, but what I always tend to suggest is you always tend to get the biggest volatility and sort of trade opportunities in the first hour and last hour of certainly the US market, the UK market, and the Asian market. Those are the sort of the three big markets that move around. The biggest movers and shakers will certainly be around the opening of the UK and European markets, and as the the markets are opening, well, as the markets are opening up in America, the UK markets tend to close in a similar kind of time. So that's where you get your volatility, and that's where your opportunities will arise. So anywhere kind of sort of 9:30 in the morning, somewhere in that vicinity, and then we can look at trading sort of 3:30 through to about 5:30. Those are generally decent times. I've got a question for you people out there. What would you like to for us to discuss in the upcoming webinars? Is there anything in particular? Got a question here from Robert. Why does gold start trading at midnight on a sub-day night instead of 11 when the Aussie market opens? I think that's just what Comex had decided on, quite honestly. Yeah. Just chatting here with my colleague Ricky Fox as well. Yeah, it's also a decent liquidity at those times, and also specifically when there's not so good liquidity. So it really does boil down to how liquid the market is at those times. If it's not liquid, then it's pointless having the actual the market open at those time of night. Okay, yeah. So it looks like we're going to carry on our sort of trail of technical analysis. A lot of you are asking for Fibonacci details, which we'll talk about. Robert will talk about candlesticks as well. I really enjoy those two particular topics anyway, so that works out perfectly for me. Yeah. So like really what it kind of boils down to for me there is price action. So how the market actually reacts to price levels. And those are two great indicators there for that. Okay, guys, I don't think there's any more questions, so I'm going to call it for tonight. But thank you very much all for listening in. We certainly will be advising you what we will be talking about through the course of the week. But thanks very much. In fact, I also want to get my colleague Ricky Fox involved next week as well. Just it's nice to have a different perspective and take on indicators as well, because obviously Ricky's technique in trading is a little bit different to mine as well. So it's nice to have 2 points of view. But yeah, once again, thanks enough, and we'll catch you next week, Tuesday at 6 o'clock.